Commercial real estate and boutique hotel acquisitions are a high-stakes arena where a single transaction easily represents tens of millions of dollars in capital. But beneath that pristine curb appeal, these assets are highly fragile. Their viability rests entirely on the math holding them up, specifically the precision of the underwriting behind the scenes. A deal can look perfect on paper, but invisible threats routinely derail returns. We're talking about hidden lease loopholes and overly optimistic pro forma math used to make a marginal property look like a winner. Spotting those landmines before closing requires highly trained eyes. The question for your investment team becomes, how do you source that critical expertise? Ultimately, whether that multi-million-dollar asset performs or tanks comes down to the quality and the total objectivity of the advisor you hire to underwrite it. The industry standard is to bring in outside help to handle your pipeline, usually a buy-side broker or a dedicated consultant. But before anyone starts analyzing rent rolls, you have to choose between two opposed compensation models. On one side is the traditional commission-based buy-side broker. On the other, the flat-fee consultant, like PRI Consulting. The trade-off? Pay nothing unless a deal closes, or pay out of pocket to guarantee completely objective advice. How you structure that compensation directly dictates the truthfulness of the advice you receive. Let's start by looking at the traditional commission model. The obvious appeal is the upfront price tag. You don't pay any advisory costs during the search phase because the fee is baked entirely into the final transaction. This chart shows the danger. While upfront cash required sits at zero, you absorb massive long-term capital risk due to broker incentives. Traditional buy-side brokers only get paid if you sign on the dotted line, creating motivation to push transactions forward, regardless of asset health. Because of that pressure to close, your advisor has a reason to gloss over dangerous lease loopholes that could restrict your revenue later. They are also incentivized to use overly optimistic pro forma math, inflating projected returns just to ensure the deal gets across the finish line. You get a free advisor in the short term, but you are the one left holding the crushing long-term liability of an underperforming property. That free advice actually carries the massive hidden cost of transaction bias. Now, let's look at the mechanics of hiring a flat fee or monthly retainer consultant. We have to openly acknowledge the immediate trade-off. As a buyer, you lose some upfront liquidity, and you take on out-of-pocket costs whether a deal closes or not. In exchange for that upfront cost, you gain decoupled compensation, the defining protective advantage. Because our compensation is decoupled from your transaction closing, we have total structural freedom. We have no reason to sugarcoat numbers, objectively telling you exactly what you need to hear. Paying a flat fee acts as a direct insurance policy against advisor bias. Outsourcing your complex transactional due diligence to a flat fee consultant does require an operational shift. Since the consultant isn't rushing to the next closing, they can step alongside your team and handle everything from early pipeline underwriting to the granular final checks. On your end, this means you need to treat the consultant as an integrated member of your team rather than a separate vendor. It replaces typical vendor-client friction with a true partnership focused entirely on the long-term viability of the asset. So, how should you structure your own advisory team moving forward? This decision tree shows how to evaluate your primary constraint to find the right fit. If you are a cash-strapped or first-time buyer, your primary constraint is capital and cash flow. If you are highly sensitive to upfront costs, and you possess elite internal underwriting to double-check the broker's math, you can safely utilize traditional brokers. Alternatively, if you are an institutional investor acquiring multi-million-dollar boutique hotels, your primary constraint is risk mitigation. You might also be a team-constrained buyer who lacks deep internal underwriting expertise, meaning you rely entirely on your partner. If you fall into the risk-focused or team-constrained profiles, you need to utilize the flat fee model to survive the due diligence process with a clean asset. The right model depends entirely on whether you can afford to float upfront cash or if you can afford to make a catastrophic mistake. There is simply no such thing as free advice in commercial real estate. The sting of paying a retainer is temporary. The devastation of acquiring a catastrophic, cash-bleeding asset is permanent. The highest return an advisor can ever deliver isn't getting a deal done. Sometimes it's having the structural freedom to advise you to walk away from a bad deal.
CRI Consulting delivers completely commission-free, flat-fee commercial real estate and hotel consult designed to bypass traditional broker bias.